The MACD is one of the most commonly used indicators by Forex traders, but surprisingly, very few people know how the MACD works. I'm Russ Horn, and today I want to show you exactly how the MACD works. I believe it's really quite important to understand the tools that you're using, and the MACD being one of the best momentum indicators, one of the best trending indicators. It's really good for all kinds of things, but the masses that use it don't understand how it's put together, and I'm going to show you exactly how it's put together, how it works, and why it does the things it does. Now, what we're looking at here is called a two-line MACD, and there's three different parts to it. We've got the MACD line, which is the blue line. We've got the signal line, which is the red thinner line, and we've got the histogram, and that's the green and the red bars that are coming out of this center line, or the zero level. We're going to start with the name. First of all, MACD. It's Moving Average Convergence Divergence. So what it's doing is taking a look at a couple of different moving averages that are on the charts that we can't see, and it's seeing how they relate to one another. Are they moving apart from each other? Are they coming towards each other? Are they crossing over? And it demonstrates this with the blue line. Now, the moving average convergence divergence, the word divergence in MACD is not divergence as we know as traders. It's simply meaning moving apart. And what this indicator does is looks at two moving averages, and if they are converging, coming together, or diverging, moving apart. Now, the standard settings for a MACD is 12, 26, and 9. So we're going to take a look at the first two settings here, the 12 and the 26. So we've got them labeled as fast EMA and slow EMA. The 9 is a signal SMA. Again, we're going to take a look at the 12 and the 26 and see how all of this relates. The 1226 is the standard setting, and what it's doing is it's looking at the 12 EMA and the 26 EMA as it's plotted on the chart. So let's do that. We're going to add a 12 exponential moving average. I'm going to make this one blue. I'm going to plot a 26 exponential moving average. I'm going to plot this one as red. And what we've got on the chart are the 12 and the 26. This is the first two settings of the MACD. Now, what I'm going to do is get rid of a lot of this stuff on the MACD. So I'll go back to my MACD settings, and under colors, I'm going to keep the blue because this is the MACD line, but the rest, I'm going to color none. And this is really the foundation of the MACD. Everything else is built upon the line that you see here. Now, the MACD is called a price oscillator. What it's doing is it's taking a look at the moving averages that are on the chart, and it's showing us the gap, or what's commonly known as the difference between these moving averages. So we're going to start with crossovers because they're the easiest to see. So if I take a look at this crossover here, where the 12 crosses below the 26, we can see that the MACD is sitting on this zero level, this line that runs through the middle of the chart. So it's sitting at the zero level because there is no gap, no space between the 12 and the 26. And we'll do this again over here, where the 12 crosses above the 26 on this big candle here. We can see again that the MACD line sits at 0. And again, that's because there's no gap, no difference between the 12 and the 26. They are at the same price. There's no pips of difference between them. So what happens is when the 12 drops below the 26, the MACD line drops below its 0 line. And 0 simply means 0 pips of separation between the two moving averages. So if we get like 5 pips of difference between the moving averages, it'll show us a 5 pip difference between the 0 line and where the MACD line is placed. When they separate a little bit further, when they diverge, we get, say, 20 pips of difference between the 12 and the 26. We'll see 20 pips of difference between the 0 and the MACD line. And this is how this relates. We can look at it like the 0 line is the 26 and the MACD line is the 12. And when the 12 gets above the 26, the MACD line gets above the 0 line. When the 12 gets below the 26, the MACD line gets below the 0 line. The gap between them is showed by the distance away from the MACD. And it's really that simple. We have a price oscillator, and that is what a price oscillator is looking at, the space, the gaps between the two different moving averages. So now comes the convergence divergence part. As the 12 moves away from the 26, as it diverges, we see that the MACD line moves away from its 0 line. As the 12 comes towards the 26 or converges, we see that the MACD line comes towards its 0 line. So the wider the gap, the farther away from the 0 line, the narrower the gap, the closer it is to the 0 line. This indicator is really good at showing us market momentum. As the market moves and it has some strong momentum, the 12 being a faster moving average will tend to separate or diverge from the 26. It'll start to get wider and wider. But as that momentum starts to fail, as that momentum weans a little bit and starts to slow down, we'll see that the 12 catches up to the 26, or vice versa. The 26 starts to catch up to the 12. And when those two moving averages start to catch up to each other, the space between them starts to narrow. So we can see the MACD line starts to get closer to the 0 line, its center line. So we can see on the MACD where there is a lot of market momentum, and then where the market momentum starts to fail. With the MACD line as well, the information that we can get is trending. If the 12 is below the 26 or the MACD line is below its 0 line, we have a downtrend. And the opposite is also true. When the MACD line is above the 0 line, we essentially have an uptrend. So we can have an uptrend that is starting to fail as it loses its momentum. We can have a downtrend that is starting to fail as it loses its momentum and gets closer to the 26 and the 12, to the different moving averages. As they start to approach each other, that momentum starts to fail. And that is essentially how the MACD functions. With the MACD, there's other stuff too. So what we're going to do is add a signal line. And that is what this one here is going to be. Color it red. And this is the 9 setting. So again, when we look at the inputs, we've got 12, 26, and 9. And the signal line is this red line, and that's what the 9-period simple moving average is. And what this is a simple moving average of the MACD line. It doesn't relate to the chart anymore. All the extra information comes from the MACD indicator itself. The MACD line, this blue line, that's what it's getting its information from the chart. But the signal line itself gets it from the MACD. Just like we put a moving average on the chart and we see an average of the candles made by the chart, we're looking at an average of the plotted points on the MACD. So this is a 9 simple moving average of the MACD line. And now we'll add in the final details. We'll go green. These are the histograms. And red. All right. So what the histograms represent is the same thing the MACD represents on the price. We're looking at the difference between the MACD line and the signal line. So when the MACD line moves above the signal line, we get a green histogram above the 0 line. When the MACD line moves below the signal line, we get a red histogram below the 0 line. And the same thing is true with this as with the MACD, the moving average convergence divergence. This is a MACD signal line convergence divergence. When there is very little gap between the MACD line and the signal line, the histogram is very little. When the gap is considerably bigger between the MACD line and the signal line, the histogram becomes very tall. So we have a better picture of overall market momentum. When the momentum is really strong, not only is the MACD line climbing quite strongly, we are also seeing that it's moving away from its signal line. And even though in this case here, we can see that the MACD line is still climbing, we get a heads up to its market weakness as the histogram starts to fail. So we have a climbing MACD line. We are seeing ahead of time its failure in momentum as the signal line gets closer and closer to the MACD line as its momentum starts to fail. This is what makes it really one of the best momentum indicators there is. We get to see momentum from the MACD line. We get to see momentum from the signal line as well. So we get two different angles, two different approaches to the strength and the momentum and the failure of the strength and the momentum of the MACD indicator of the market. This is a wonderful indicator, and this is how it's built. It's really quite simple, but now that you know how the MACD works, you'll better be able to use this in your day-to-day trading. We can have a downtrend with green histograms. This means that we have a downtrend and the momentum is really quite weak. And as that green histogram turns red, we can see that the momentum is starting to gain strength. In an uptrend, we can see that we have an uptrend as the MACD line remains above the zero line, but the momentum of it becomes very weak as the histogram turns red. But then as the histogram turns green, we regain that upward momentum and then the market can take off. So we've got that uptrend because the MACD line is above the zero line and a resumption of that upward momentum when the histogram turns from red back to green. It's kind of like seeing a pullback. If you want to trade the pullbacks, this would be a great way to do it. We have the market losing its momentum and then regaining its momentum. And at that point, we can take another trade and capitalize on this newfound push, this newfound momentum that the market has taken. So enjoy the MACD. Now that you know how it works, you can put it to good use.